So the business awareness is a very brand new paper for the AAT. And the reason AAT introduced this paper because they removed the synoptic. So there is no more synoptic in the level 3. And instead of the level 3 synoptic, they introduced this paper, and that is business awareness. Now, there are a few things that comes from the synoptic paper, but actually so many things we're going to learn from this paper that wasn't before in the level 3 at all. Now, the first thing we need to understand, this paper is a completely theoretical. So the way we have done our ethics, and ethics was completely theory, and the ethics will be mixed here as well with this paper. And top of that, they have introduced a few new topics. For example, the business analysis. Now, the business analysis wasn't part of the level 3 before, but this is the first time they're introducing on the level 3. When you say the business analysis, what does that mean? That means how to analyze the environment of the business. Now, of course, like all of us, we know like the business always look for the making the profit. So the main goal or the main purpose of the business to maximize the profit or maximize the wealth for the shareholder. But at the same time, so we heard about the all right, so we will talk about like the financial perspective and the non-financial perspective of the business. Now, it was or still the main purpose of the company or the business is to maximize the shareholder wealth. That means making the business profitable as much as possible. This is the main goal for the business. But nowadays, the company or the business become more competitive. So you have a lot of competitors. They try to do something different, and they try to show to the country, to the people, to the customer that they are doing something extra that not everyone doing. And this one is called CSR, or corporate social responsibility. Nowadays, it's become very much common for every single business, and every single business, they try to show something to the people or to their customer, like they have some responsibility towards the society, towards the country, towards the people. For example, if you look at the Tesco, they said they give some charity to save the Children and Cancer Research UK, for example, as they said, they give some donation to UNICEF. For example, some companies said they don't use any plastic anymore. They use the recyclable product. So this sort of thing, they try to show they have some responsibility. Now, even though it is not mandatory by law to do so many things, but still they try to show it. They have some responsibility or some sort of accountability to the customer. And from that point of view, or from that time, it's been like 10 or 15 years, all the company, they try to do something unique to show they have some responsibility for the customers, for the country, and some people, they appreciate it a lot. For that reason, it's become a very important topic or area for now every single business. Now, the business have a financial perspectives and the non-financial perspective. Every single business we have, they analyze both factors. Now, for example, if your business is a very profitable, and if you don't look at the non-financial factor, for example, the customer satisfaction, the customer complaint, so this sort of thing, if you don't deal it properly, at the end of the day, it will have a impact on your financial perspective as well. For example, let's say if the customer come to you and they have to wait, for example, long time for the service or for the product. Maybe the product you sell to that customer, it is not that qualityful, and the customer become upset, or maybe you don't have a return policy. So if the customer buys something, they cannot return it. So this sort of thing nowadays has become very common, and every single company they try to show something to the customer, they are doing something extra. So all the non-financial factor become important for the company nowadays. So it is not only the sole purpose for the company to do the business and just making the money. So they have to look after the society and the responsibility and some sort of accountability to the people. Now, the business awareness will give us this sort of ideas, and it will tell us what is the responsibility of the directors, what is the responsibility of the shareholders, and in general, as a whole, what is the responsibility of the stakeholder. Now, when you say the stakeholder, that means a lot. Almost everyone is a stakeholder for the company. For example, the employee, the shareholder, the government, the customer, the normal people, everyone kind of a stakeholder. Because of the business decision, they have some sort of impact. So we're going to look at all of this. Top of that, in addition of that, we're going to look at some sort of environmental impact. When I said environmental impact, what does that mean? That means to analyze the environment for the business. Now, there is a very common approach that we use to analyze the environment. We call it pestle analysis, PESTEL. Some of the company, they just do pest analysis. So they don't do the L, they just do the pest analysis. So here we look at the political side, the economical side. So every single thing have impact for the business. So we're going to learn all of this from this course. This course will be fully theoretical based, so you have to write a lot in the exam. So if you think your typing is not very good, or if you cannot write well for the exam, you need to make sure your typing has to be improved. And obviously, like, you have to be get used to with the writing. We know, like, some of the student or maximum student, they don't like the writing thing. But for this paper, we don't have any choice. We have to make sure we are very much okay with the writing, and the writing skill is very important for this paper. Now, if we look at our chapter overview or the content, we have 7 chapters, and we'll complete this course in 5 weeks. So try to complete the book in 4 weeks. We'll talk about the chapters in 4 weeks. And week number 5, we'll do some sort of revision. And week number 6 will be your exam week. Now, as I said to you, that will be a little bit discussion paper. So there is no calculation, there is no number. So it might be a little bit boring sometimes, but there is no choice. We have to learn, because this is a mandatory paper for the level 3, and we have to do it. All right. Now, if we look at the exam structure, and obviously, like, if we have a look, from here, so what will happen, the exam structure, if you give me a second, one student saying if she need a link, just give me a second. So if we have a look at the exam structure, so you can see the exam will be on computer based. So the way we did other exam, it will be the same way. We have to sit down in the computer, have to do the exam on computer base. And the exam will be marked by computer and partially by human. So that means you're not going to get the result immediately. You're not going to get the result immediately for that. So you have to wait 5 to 6 weeks for the result. The way we used to do our synoptic paper is going to be same. So you have to wait a few weeks for your result. The exam duration will be 2.5 hours. So we have to write almost 2.5 hours to answer 7 questions in the exam. So there will be 7 tasks, and we have to perform these 7 tasks within 2.5 hours. If we look at the structure of the question, so we can see here 2.5 hour exam duration, competency 70%, and obviously like we have to answer 7 questions in the exam. And the first question will ask from the organization and ethics for an accountant. We're expecting 20 marks from this question. And the chapter will cover that business types, organizational structure, and professional ethics for an accountant. Number 2, we'll have analysis of the external environment for the business. We have a pestle analysis and companies and partnership that will cover for 18 marks. The technology, cyber risk, and the data security will give us another 17 marks in the exam. Then we have the ethical and the legal compliance that will give us another 10 marks. This will be involved with the ethical issue and the money laundering. Question number 5 will have a microeconomic environment and sustainability. We'll have 10 marks from here. We'll cover here demand and supply, sustainability, and the stakeholder. Communication and visualization, we have 13 marks from here. And that will be entirely writing task requiring to you analyze the data information presented to you in the variety form. For example, you may be required to analyze chart or diagram to explain the performance of the business. So on our revision session, when you're going to open exam question, we're going to look at what type of question will come from question number 6. Question number 7 will have risk and big data. So that will be our risk strategy, type of risk, data and the big data, decision-making, quality of the information, and source of the information. So this sort of thing will cover our 7 tasks in the exam. All right, so now if we move to our chapter number 1, we have a 7 chapter to do, and we'll try to do 2 chapters each lesson. So in 4 class, we'll be able to finish our 7 chapters. Then we'll do our revision and we'll do our exam after. Okay, now the first chapter is the cover of the type of businesses. So from this chapter, we're going to learn how many types of business we have, how they operate, what is the legal requirement and the compliance on that business, which business is suitable for what person. So we're going to look at all of these things from that area. So we'll move to our chapter overview and going to talk one by one about every single business we can operate in the United Kingdom. So the first thing we can see, we have types of businesses and we have organization exit. So unincorporated business. Let's talk about this one first, unincorporated business. Now, if we try to talk about the unincorporated business, so the simple word is you don't have to tell the company house that you have a business. You really don't have to tell the company house that you have a business. So you don't have to incorporate your business with the company house. Now, what does that mean? That means if you work as a self-employed, when you work for yourself, we call it self-employed. So the way you work for yourself as a self-employed, the same way you can do the business for yourself. And when we do the business for yourself, you really don't have to open a company. So you can, rather than work, you can do the business and you really don't have to incorporate it to the company house, and that is all about the unincorporated business. Now, if you like to look at example, the first example is sole trader, and the next example is partnership. Even though it is possible, the partnership can be limited, but it's not always the case. You have a choice. You can open a limited liability partnership, or you can open an ordinary partnership. Here, we're talking about the ordinary partnership where we don't have to incorporate the business. Now, let's talk about a little bit in general to understand in detail. Let's say, for example, one person decided to work as a plumber, or one person, let's say, decided to work as a private tutor, or maybe a pest controller, or maybe a electrician. So this person, what he do, he put some advertise and said like, I am available 5 days or 6 days to provide these services. That's my number. If you need me, you can give a call. If you have any problem on your home or with the boiler, so you can call me, I'll come and fix for you. Now, this one, what type of work it is? This person have no idea how many calls he going to receive today, how many calls he going to receive tomorrow. So that means it is not the employment. It is not the employment. It is a self-employment because he worked for himself. Now, the real definition of the self-employment and the employment is employment have a contract. So you have a contract with a company, and the company will give you a certain number of days or hours to work. Every week you go to the same place to do the same job or for the same company. Is the understanding of our employment. On the other hand, self-employed, they don't have any contract with one company, but they provide the services to different companies. And they really don't know how many companies they're going to offer the services, but they do services for a lot of company. On the employment, the company going to give you everything. For example, if you need a desk, if you need a computer, if you need any sort of equipment, the company going to buy or provide to you for the work that you're going to perform for that company. But if you're self-employed, you have to buy your thing by yourself. So you have to use your own car, your own tools, and everything that you need to perform that work. If you are work as employee, you will have a right of the employment. So you will get the employment right. That means you can get a statutory holiday, maternity, paternity, and the sick payment, this sort of thing. All the statutory thing you will get from the company. If you're self-employed, you will not get any of this. So this is the little understanding about the self-employment and the employment. Now, what happened if someone said like, listen, I'm not a plumber, I'm not an electrician, but I want to open a chicken chip shops in the street, or I want to sell a flower. So I'll buy some flower from the village or from somewhere else or from any other country, and I'll sell in the street market, or I will make a small shop and I'm going to sell this flower there. Now, this time he's not working to going somewhere or providing some services, but he's doing sort of business. And when he going to start this sort of business, but he's working himself, maybe he can recruit 1 or 2 employees, but the business will be very small and very small in nature. Then we called it sole trader. So the difference between the self-employed and the sole trader is not very much. Sole trader, when you sell something as a trading into the business, but the self-employed, you just do the work. That's the difference. So when you do sole trader and the self-employment, from the HMRC point of view, the way you submit your tax return to HMRC is 100% same. So there is no difference between these two, the self-employed and the sole trader. So all the things you do, for example, you look at how much is your income, how much is your expense, how much profit, how much tax. The way you calculate for the self-employed person, you do the same thing for the sole trader. So this is one of the things very common. And this is sole trader. The next one is the partnership. The partnership is like sole trader, but here more than two people or two or more people is involved in the business. So when two or more people have a mutual understanding and mutual agreement for a business. So for example, they said like five of the friend, for example, the five guy, the restaurant. So five friends, they are together and start a business. And this is with the basis of partnership. Now, the partnership don't have to have a legal agreement, like what will be the profit ratio, what will be the interest on capital. Is not mandatory, but to run a business is always better. The partnership have a sort of agreement. So it will be written what will be the profit ratio, which partner will take the salary, which partner will take the interest on capital. So this sort of thing will be on the partnership business. Now, at the end of the year, the partnership business will be treated as an individual income. Remember that. So from the business point of view, the business will not pay any tax to HMRC, but at the end of the day, it will be calculated how much is receiving by which partner. For example, if we have a three partner, A, B, and C, so HMRC is going to look at how much A is getting, how much B is getting, and how much C is getting. So the tax will be charged individually with the partners, but not with the partnership business. For example, from the partnership business, if you make a profit of 50,000, there will be no tax on this 50,000. Rather, we will see this 50,000 will be distribute or share between the partners. And after that, we'll add it how much each partner is received. For example, partner A is received the salary 10,000 and the profit 20,000, so it's 30,000. So the tax will be calculated on 30,000. Maybe partner B received profit only 10,000 and no salary, so the tax will be on 10,000. So it depends on the individual earnings, the tax will be calculated. Now, as we discuss both, we understand even though sole trader is a business, even though the partnership is a business, but the business don't pay any separate tax to HMRC. So it's the individual, it's the people who run the business, they pay the tax individually. This is the main difference between the sole trader, partnership, and the limited company. The limited company, there, the individual people don't pay any tax for the business. The business itself has to pay the tax, and we called it corporation tax. So this is the main difference for the companies and for the unincorporated business. Now, it is possible you can start the business in a small nature, and in future, if the business is bigger, then you incorporated it. For example, you start as a sole trader because the small business is now small. After 5 years, maybe the business is bigger and you have decided to incorporate it, and it is possible you can always incorporate your sole trader business and make it limited companies. So it is the basic understanding. The next one we have here, that is incorporated business. The first one, you have a private limited company. So when you have an incorporated business, that means we have to register with company house. So you have to open the business with the company house. It's a very simple. If you're planning to start a business tomorrow, in 24 hours, it is possible you can register for the business today. And next 24 or 48 hours maximum, you will receive the corporation certificate from the company house, and you're ready to start your trading. So this is the big benefit or advantage in UK. you can start your business immediately. So it will not take long by the company house to give you the corporation certificate and approval to start your trading. So you can start your trading immediately. Within 24 hours to 48 hours, the business can be ready to go. So the first thing you need to do, you need to go to the company house. So you need to look at the name we have selected. Now, of course, like the name cannot be offensive. You cannot use the name that shows a violence or crime. You cannot do that, number one. Number two is the business has to be, of course, like not linked with anything that is against the law, and you cannot use any name that is a link with the royal. For example, you cannot use the name queen, or you cannot use the name king. So this sort of word you will not be able to use with your company. The company name always has to be ended with the limited, LTD. You have to use the word always LTD, that is limited. If it is private limited, it is LTD. If it is a public limited, then it is PLC. This is the main calculation we have for this business. This is the main understanding we have. Now, when you have a limited company, that time the people or the shareholder or the owner of the business, he will be treated separately from the business. And we call it separate entity concept. Separate entity concept means the business and the owner are separate. The business and the owner are separate. So even though the business owned by that shareholder, the owner, but still the business and the owner will be treated separately. And we called it separate entity concept. The next thing we need to understand the difference between the private limited company and the public limited company. What is the difference between these two? The private limited company is the company that trading and mainly the control stay with a few people. For example, there might be one shareholder, two shareholder, three shareholder, and if they are private limited company, they will not be able to sell their share in the stock market. So they cannot raise the money from the market. That means from the public, they cannot sell the share into the stock exchange to raise the money. So that is a private limited company. And the public limited company is they have to register in the stock exchange and they can sell the share to the general public, the way you can see Tesco or Asda or Sainsbury, this sort of company. They can sell their share in the market and they can raise the capital from the market. So to do this, they have to go through some process to become a public limited company. You can start your business as a private limited company. And later on, if the company is really big, it is possible you can list it as a public limited company in near future. So public limited company is basically they're listed with the stock exchange. Now, every single company will have a two side. Either it is a private or it is a public, doesn't matter. It could be the profit-making organization. For example, they can solely do the business to make the profit. For example, Asda, Sainsbury, Tesco, the way they do their business. And it is possible the business can be run for the best interest for the public. For example, NHS, for example, the TFL, for example, this sort of business, the NGOs, this sort of business, they makes a lot of money. They makes a lot of money, but they don't take the dividend. That means the owner, the shareholder, they don't take any money from the business, from the profit. So how much profit they make, they always reinvest into the business to make it more suitable or make it more better for the general public. So this is the main intention for the non-profit making organization, and they work for the best interest for the people, for the public, not to maximize the profit. The next word we have here, LLPs and a limited liability partnership. This one, as we discussed before, it is possible that partnership business can be limited liability. So you have a two form of partnership. One is ordinary partnership and one is limited liability partnership. So if you're ordinary partnership, you don't have to be incorporated with the company house. If you are a limited liability partnership, you have to enroll with the company house, have to incorporate it, get the incorporation certificate, and that time you will be treated as a limited liability company. And that time the liability for the partners will be limited and they don't have to bear the unlimited liability. The next one we have, we call the shareholders. Now the shareholders is the actual owner of the business. Shareholders are the actual owner of the business. Actual owner of the business. Now, sometimes we get confused. We think the directors are the owner of the business. Remember, this is not true. Directors are not the owner of the business. Directors are the people who direct the business. They are just employee. It is possible the shareholder can be the director. For example, you open a business, you 100% own this business, you are the shareholder, so that means you are the owner of the business, and also you are the director. But it is not necessary the director has to be shareholder. So director can only be the employee. For example, if you look at the London Excel, or if you look at the DLR Train, this sort of company is owned by the Abu Dhabi company from Dubai or from UAE. So these people don't live here, they don't come here, they are the shareholder. So they are the actual owner of this sort of business, but they recruit some people, some employees, some directors, they run the business. They took all the responsibility to run the business, but the shareholder don't have to be involved if they don't want to. Right? Explain liability part. Okay, Bushra, so we can talk a little bit about the limited liability. So for example, let's say we have a business, and this business, for example, this business, it is a sole trader, for example, it is a sole trader. Now, when I have a sole trader, my liability will be unlimited. When I'm a sole trader or partnership business, my liability will be unlimited. What does that mean? That means, for example, if I take a loan from the bank, for example, if I take a loan from the bank, let's say £50,000, and I use this loan into my business, and for some reason, I lose all the money. I have no money to pay back that loan to the bank, and somehow the business making the loss, and I lost all the money I took as a loan. So if this is happened, I have to pay this loan back by selling my personal asset. For example, the bank can come to me and sell my house or sell my car or any asset I have to pay off the loan. So for that reason, we called it unlimited liability. But think about not sole trader. If we think it is a limited company or LTD. So if it is LTD, then my liability will be limited. This is the main advantage of the limited company. So my liability as a shareholder will be limited. What does that mean? And that means, for example, in the business, when I start the business, if I inject as a capital, if I put the capital 10,000 pound, and if I take some loan from the bank, or if I buy something from my supplier, and if I have no money to pay it back, or if I have no money to pay to my supplier, so I can only lose maximum 10,000 that I have invested in the business when I started the business. So they will not be able to come to my house or to my car to sell it and pay back their loan. So as a limited company, my business and me are separate. So they can come to my business, they can see what asset I have on the business, they can sell everything, they can take, but they cannot ask me anything personally to sell it and pay their loan back. So this is the difference between the sole trader and the limited company. And that's how the liability works. When I said the liability is limited, that means if I have a limited company, my liability only up to the amount I have invested in the business, nothing is to my personal asset. For that reason, during the COVID time, we have seen like the Barton, Dorothy and Parkins, River Island, this sort of company, they closed, and the owner is still millionaire. They're still billionaire. Why? Because the company is a limited company, so they only lose the money they invested on the company, so it have no impact on their personal asset at all. All right, so this is our definition of the limited and unlimited liabilities. The next thing we're going to talk about the directors. Let's talk about the directors. Now, the directors are the people who run the business. Directors are the people who direct the business. For example, if we drive a bus, there will be a lot of people on the bus, but the driver who drives the bus, he is the director. So when you have a business, we have a lot of employees, we have a lot of management accountant, we have a financial accountant, we have a lot of supplier, we have a lot of people involved with the same business. But the people who will give the direction, they are the directors. Now, within the directors, we have a two group. We have executive directors, we have a non-executive directors. For the time being, we really don't have to understand it. It is kind of the topic you're going to learn when you will do your charter accounting in future, so you'll learn in detail. For the time being, just understand the directors are the people who run the business. And this is the people who is ultimately responsible for all the action taken by the business. For example, to keeping the record up to date, to submit the return to HMRC, to file the tax return, and follow all the compliance. So all the things, compliance thing will be maintained by the directors. So if anything happened with the business, anything happened wrong with the business, these people, the directors will be responsible for that. So these are the people, ultimate responsibility they have towards the business. And they have to do everything on behalf of the business, except one thing. If the business need to enter into any contract. So for example, if the business need to buy an asset, if the business need to buy land, if the business need to enter into any contract, they don't have to use their name. So the director don't have to use their name, because the company will be treated itself like a person. So the business can buy the asset on the business name. So we really don't have to use the director name, because the director is like employees. They're working today, tomorrow they can leave. So obviously they will not take the asset with them. So business can buy the asset on the business name. They don't need the director at all. But to fulfill all the responsibilities, all the compliance, this is the job, and the director will be accountable for that. All right, so the final thing is the capital. Normally the business Limited liability companies introduce the capital by the owner, and it is a public limited company. The finance or the capital can be raised from the market by selling the share. All of us, we know the share price goes up and down. So every day the market could go up and down. It's only for the public limited company, not for the private limited companies. So this is the little explanation or briefing for the things we have, the business we have in UK. So if you like to do any business in the UK, we have only few options. Either we can be a sole trader, either we can be in a partnership, or we can open a limited company. We don't have much thing. And so this is the only way you can do the business in the UK. If you are a charity, this is a different story. You can register with the charity commission, but that's a different thing. But if you want to do the business where you have intention to make the profit, this is the only way, either sole trader, either partnership, or the limited company, you will start the business. Now, which one is more suitable? It depends on your situation. Where you think you have a lot of risk on the business, you might go for the limited company because you don't have to worry if something goes wrong. You have to pay by selling your personal asset. But if it is less risky, you can always go for the sole trader because you have some other advantage and you have a less compliance from the HMRC or from the company house if you are a sole trader. All right, so any questions so far from anyone? Anyone have any question? All right, very well done. So then we can talk about a little bit what we have here. Now we have discussed few things, obviously, and now we have some explanation here as well. So the first thing we're looking at, the profit-seeking organization, and this one is the obviously most of the business, they look for the profit. Obviously, if you look at the percentage, you will see like maybe 98% people, they do the business to make the money. But maybe 1 or 2% company, they are NGO, they try to do something for the country, for the people, like a charity. But most of the company is a profit-seeking company. So the way profit-seeking company make their money, they have to sell. This is very simple. They have to sell, and they have to make their sell more to make it more money. And after that, they have to minus how much is the cost. For example, let's say if we sell this pen, and if we make this pen for £5, and if we sell this pen for £10, so I'm making a profit of £5. So my cost will be minus from the sale to get the profit. This is very simple calculation. How much is the profit? That is income minus expense. Then I look at the cash flow. How much cash is coming to the business, how much cash is going from the business, because when you prepare the accounts, you prepare the accounts based on the accrual concept. And according to the accrual concept, what we understand? We understand, doesn't matter we make the money or not, we receive the money or not, or we paid the money or not, we have to record for that period. And for that reason, we need to look at the company financial statement and also the cash flow statement, because cash flow statement will give us the idea how much cash actually we have. Because if we don't have enough cash, our working capital will not be moved and we'll be in trouble with the liquidity. And then the customer needs. So sometimes you have to follow the customer needs. So sometimes based on the technology and other factor, the customer demand can be changed. And we have to always look at that. Competitor auction. So comparing the product, service, and strategies. What is my competitor following? Maybe this will be one of the factors that I have to consider. So for example, if all the competitor reduce the price, I cannot keep the price up. So this product will be not purchased by anyone if I don't follow my competitors. Then we have a charitable organization. You understand the charitable organization, and they're running to help the people or some sort of organization. For example, Save the Children or Cancer Research UK. This sort of organization, they are mainly focused to do something for the people, and they don't sell anything, but they receive the donation. So they receive the donation from the people, from the company, from different sort of financial institution. So their income come from the donation or from the grant. Grant is something they receive from the government. And obviously internal cost management. So charity is financially sustainable, and technical data, how well this charity meeting the charitable aim. So this sort of thing, when you open a charity, you have to identify what is the aim and how you're going to collect the donation, how you're going to spend this donation, how long you will be suitable for. For example, sometimes you see like some of the charity, they run for, like, for example, help the old people or help the disabled people, but if there is not enough donation, they'll not be able to run for long run. So is it sustainable? Sustainable means like for the long run, is this business will be still continue for foreseeable future or not? So we can look at from that point of view. Then we have a non-profit making organization or the public sector. Here we talked about, for example, the TfL, the London Underground, or for example, the NHS. This sort of organization, they are not profit-making organization. They are working in the public sector. Even TfL making millions every day, but actually they are still treated as an NGO. So their profit could be billion, but they use this profit to improve the service for the people, not to take the dividend or take the profit from the business. Now, there is three things we have to remember from here. That is 3E, economy, efficiency, and the effectiveness. Economy is all about like how economical we are. So economic, we can say the cost effective. So for example, with the minimum cost, can we get the best service? Or with the government budget, how much they give it to me, can I survive or can I cope with that? So always hard, there's a shortage of the budget in the NHS, this and that, because the economy maybe is not working very well. So obviously if you spend more, if you waste more, then it will not work. Economy is like how cost effective we are. So with the minimum cost, can we provide this service or not? The efficiency is all about how efficient we are. For example, if a doctor take 1 hour to see a patient, and if another doctor or another GP, they can see 4 patients in 1 hour, so that GP will be more efficient because they spend less time and they provide more services. For example, if you stay on the queue to get a burger from McDonald's, so if you have to stay 5 minutes, and if another branch they provide this service really fast in 1 minute, they're more efficient. Effectiveness is all about like organization meeting their target. So if the target is fulfilled, and you can compare with others. So for example, if you says like, okay, this year our staff turnover is 10%. And the same year, if you see with the other competitor, they have like 12% or 15%. So you can compare, you are doing good or bad. For example, if you say like your sales is increased for one branch is 10%, and another branch or another competitor, their sales is increased by 15%. So you can compare like you are doing good or bad than them. So by analyzing the effectiveness. So this is basically all about like when you have a set of target, if you cannot fulfill the target, your effectiveness will be lower than the standard. Then we have a service organization. We have a healthcare, banking, accountancy, legal service. The difference between the service and the product. So when you have a manufacturing business, what we do, we make something and we sell it. But when you have a service business, we don't make anything. We don't give any physical thing. For example, if you go for a haircut, so you pay the money, but you actually don't get anything physical. So for example, if we use the electricity or internet or for the phone bill, we pay for that like a rent, but we don't get anything physical. We pay for the service, but we don't get anything physical. Most of the time it is intangible. We don't see it, the product, but obviously we pay for that. This is the definition of service. So the service and the product is like product, you get something physical. Service, you don't get anything physical. For example, the solicitor give you some service or the accountant give you some service. You don't get anything physical. For example, the consultation, this sort of thing, like professional service you get from the people. And this sort of thing is kind of like is intangible. All right, so we have one example here. Let's have a look this example. So let's read this example. Activity 1, hospital manager. Mina has been tasked with preparing a range of performance metrics for her hospital so that its performance can be compared to other hospitals in the region. Mina has drafted 3 measures, but it is unsure how to classify this. So she wants to compare, they're doing good or bad compared to others. So economy, effectiveness, and efficiency. We have some description here. So we have the survival rate for the breast cancer patient is 81%. Each consultant treats an average of 18 patients per week. The staff cost exceeded budget by 2.5% last year. So which one belongs to which category? So I'll give you 5 minutes to have a look and give me some answer, then we will solve it together. That's very good. So the first one, we have survival rate that belongs to effectiveness. Very well done. Then consultant treat average 18 patients per week. So how efficient they are. So let's go with the efficiency. Very good. And the staff cost exceed budget by 2.5%. That's economy. So it's relevant to how cost effective they are. Very good. All right. So in the exam, you will have a lot of questions with the multiple choice question. You have to just pick and choose. You have to just choose the true and false. So this sort of question will be quicker for you to understand it. All right. So the next thing we'll have talked all of this thing. Let's talk about a little bit about the goodwill. What is goodwill? How does it work? Now, the first thing we need to understand, the goodwill is something that is not allowed to generate it internally. So for example, if you have a business, you are not allowed to generate the goodwill internally. Why? Because it is very hard to justify. It is very hard to prove the value of the goodwill. Now, for example, let's say you have a business. You have a business, and this business, you think it is a very good, you think you made the wonderful business, and you think your business is better than anyone. So what will happen? It is possible you might put a value 1 million for the goodwill. But is there any people outside who is willing to pay 1 million for your business? That's the question. So you can think your business value is 10 million, but if the people is not willing to pay for that, that will be misleading the information on the financial statement. For that reason, we are not allowed to create, or you are not allowed to record the goodwill on the financial statement that is internally generated. So what does that mean? Internally generated. That means I cannot just decide the value of the goodwill of my company and record on the financial statement. I cannot do it. Then when and why the goodwill is created? The goodwill will be created only the time when I'm going to sell my business. For example, let's say I have a small shops. Let's say I have small shops and I have sort of equipment. So I have some furniture, I have some equipment, I have some sort of like machinery. So I added the price. For example, if I said my furniture is £5,000, my equipment is £5,000, and the machinery is £5,000. So the total value of the net asset is £15,000. So if I can sell my business more than 15,000, that will be because of the goodwill. For example, if I can sell my business for 20,000, so 20 minus 15, the difference will be the goodwill. So let's try to understand a little bit in details. For example, you start a business 2010 and you invested 15,000 money, 15,000 of capital of your money, and you have buy this the furniture, the equipment, all you need for your business. And from 2010 till 2022, this 12 years you have done the business and people now know your business. You have some customer, you're doing really good now, even though the machinery or equipment is a little bit used now or old now, but your business now going good. People now know your business. People come to you because you sell the good product or good service, whatever it is. Now, if you decide to sell this business to someone, and if that person said, listen, how much you have invested when you started this business? And you said, I invested £15,000 12 years before. And they said, okay, fair enough. If you invested 15,000 12 years before and it is old now, so I will still give you 15. And you will say, no, I'm not going to take 15,000 now, because last 12 years I have done a hard work and I have make a reputation and people know my business and I have a lot of customers. The business has some value, and the value is for what? For the reputation. So you will ask maybe 5,000 or 10,000 extra. So you say like, I'm not going to sell it for 15, I'll sell it for 30,000. And maybe that person said, no, 30 is too much, I will give you 25. So whatever will be the negotiation and the agreed price. So the difference between the agreed price and the net asset will be the goodwill. So for example, if the agreement happened like for 25,000, so the 25 minus 15, 10,000 will be for the goodwill. So this sort of calculation, that time, if someone is buying your business, only that time you are allowed to record this goodwill on the financial statement. Other than, you are not allowed to record the financial statement, the goodwill on the financial statement for the companies. But for the partnership, the treatment is a little bit different. When you have a partnership business, it is possible the new partner join to the partnership business. It is possible the old partner can leave the partnership business. So when the old partner retire, or for any reason, if he leave the partner, so before he leave the partnership, he want to revalue the business. For example, three people started the business, for example, 12 years before, and after 12 years, one partner said like, I'm very old now, so I want to retire. So if the person want to retire, so he will take his money back. Now, let's say in 12 years before he invested 5,000. Now he's not going to take 5,000. He will say like, in 12 years, the business is now really big, so I want more. How much more? It depends how much is the value of the goodwill. So they have to agree in a price, they have to increase their capital, and they can take the money as a capital from the business. So for the partnership, it is a little bit different. Also, like when the new partner try to join to the partnership business, for example, we have a 12 years old partnership business and someone try to join today. So he need to pay some more money that we have paid 12 years before, because we make the business for 12 years. So he need to pay some extra because of the goodwill. So only for the partnership, when the partners retire and the new partner join, that time we are allowed to record the goodwill. But if we record it today, tomorrow we have to eliminate. We cannot keep the goodwill on the financial statement. Very carefully that. All right. Let's talk about our incorporation. We talk private limited companies. We talk public limited companies. We talk, and what else we have? Okay, so when you open a company, let's talk about a little bit about that. The duties of the directors. So here, the duties of the directors: the duty of the account of any money, good receive, service receive, avoid of conflict of interest. Conflict of interest means like you should not do something that you know it will be not best interest for the company you work for. For example, if you are director of Tesco, you cannot work as a director of Asda or Sainsbury because they're competitors. So this sort of thing creates the conflict of interest. So you should avoid the conflict of interest if you are directors. Duty to disclosure. So obviously, if you do any other work except for that company, you have to disclose this information to the company. And not make any secret profit. You should not make any secret profit. For example, sometimes what happened, the director buy the product from the supplier, and the supplier try to make happy the directors. The supplier said, okay, if you buy from me the raw material or something, I'll give you some sort of commission. So the director choose from that company rather than, or instead of buying that is cheaper they can find from other companies. So he's not working for the best interest of the company. So he's not allowed to do that. So the director have a responsibility to always do something that is best for the company, not for his own interest. Then we have a statutory duties. Obviously, statutory duties that is set out by the company house. Now, on the company house, we follow the Company Act 2006. So all the rules we have for the limited company, this is under the Company Act 2006. Now, obviously, when you open a limited company, there is two official documents you're going to receive from the company house. The first one is the Article of Association. The next one is the Memorandum of Association. You can make your Article of Association the way it is relevant to you, but there is standard format that always come from the company house. Also, top of that, you have a share certificate and the corporation certificate, and it shows all the rules on the Article of Association, and the memorandum is still like what sort of responsibility you have as a director, what you can do, what you cannot do, just explain everything, and you have to agree with everything to open a limited company. So here it says, run the company in accordance with the articles to promote the success of the company, exercise independent judgment, exercise reasonable skill, avoid the conflict of interest, avoid the benefit from the third party, declare the interest of the transaction that we have discussed. All right, shareholder, we said shareholder, the actual owner of the business. We discussed that it is not necessary shareholder have to be in the business. That can be somewhere else. They own the business, but the business will be always run by the directors. We have some meetings, so the meeting and the resolution. Now, normally, this is the main and important one. We called it AGM, Annual General Meeting. This one happened once in a year. When the AGM happened, all the shareholders go to see the directors and the auditors and the accountant. That time, the director has to say, like, that's how I run the business. That's the reason we make a profit. That's the reason we make a loss. They have to explain everything on the stage, and the shareholder will be sitting like the audience. Now, if the shareholder is not happy with the director, they can make a vote and they can remove any directors they like. So they can decide like you will stay or you will not stay. So they have a power to remove that, except that they don't see the director normally. For the public limited company, they don't see the directors. They just see once in a year. But if the situation is really bad, something is going very important, they can call the EGM, that is called Emergency General Meeting, and they can call all the shareholder, but at least 5% of the shareholder has to be together to call the AGM. All right, then we have a resolution. So resolution, normally if you try to pass a law or some new rules, so this requires a simple majority of the vote cast at a meeting to be passed. These are used to approve the accounts and appoint or remove the directors. Special resolution, you need 75% if you really don't have to do something important and you want to do changes on the article. For example, you want to find the insolvency policy or instigating the insolvency policy. Insolvency policy or the dissolving the company is very important. If you like to go for the liquidation, how you do that? If you like to change it, is important matter. So 75% of the shareholder need to agree to do that. All right, so let's look at the difference between the partnership and the company. So is the owner personally liable? For the partnership, the answer is yes. So if something happened, the partnership need to pay the money from his own pocket. The company answer is no. They are not liable anything personally. Senior management, we called it partners. For the company, the senior management, we called it directors. Requirement to register with the company house. For the partnership, no, they don't have to register with the company house. For the company, yes. Method of taxing, it will be individual tax. So partners pay income tax on their share of profit, but the company pay corporation tax. The company is separate from the shareholder. Annual general meeting for the partnership is optional. They can have a meeting, they cannot have a meeting, up to them, but for the company, it is by law. And also, if it is a limited company, if it is a public limited company especially, they have to publish their financial statement, like their profit and loss account and the balance sheet and the full accounts in the newspaper. So they have to publish it to the local newspaper so that all the people can see it. So it's by law, they have to publish on the newspaper. All right, so let's move on. We have a limited, we have to talk about that. Let's look at our one more activities we have. So as we discussed before, for the sole trader and the partnership, sole trader, where the risk is less and the business is small, is better to start as a sole trader. But the company where the risk is more, so you think like you might lose the money or someone can do something, so you have to pay a lot of money for that. So it's better to go for the company because I don't have to pay something personally from my pocket. So this is the scenario. I'll give you 5 minutes to read the scenario to find the answer for that. And after that, we'll solve it together. So most of you are saying that Megan should trade via sole trader and Curly should trade via limited company. Now, of course, like instead PLC or some people said public limited company. So we'll go for the private limited company, private limited company, private limited company. Okay, so the reason is like she will not be able to make a public limited company with just to have a small business. To open a public limited company, you have to have a big company and you have to have a corporation different way. So it is a little bit different when you're trying to sell the share in the stock exchange and you have to raise some money. That goes with the public limited company. But here, the main point here is the Megan have everything. So you just need to make some sign and she already have most of the tools and there is nothing risk we can see involved here. For that reason, we can say you can go with the sole trader because they don't have much risk. With the Carly, you can see she's saying like before there have been some issues. The team is aware that other tax advisors have been sued for considerable sum when they have the like the client give the wrong advice. So it is possible if they don't take the action now, they can end up with the same thing and the client can sue them and they have to pay a lot of money for that. So for that reason, if he open a limited company or if she open a limited company, what will happen? At least she will be safe like as a limited liability and she will not be able to liable personally for any debt that is claimed by the client or someone. So the company will be responsible. So nothing to lose beyond the investment they make the company. All right, so any question from this one from anyone? Anyone have any problem understanding that? All right, very good. So it is the end of the chapter number 1. So let's move to chapter number 2, that is organizational structure and the governance. And before you start, we'll take a break. So let's take a half an hour break and we'll come back and we'll start with our chapter number 2. So I'll see you, let's say 7:50, we'll start again and we'll start from chapter number 2. So chapter number 2, we have organizational structure and the governance. Let's try to understand these two words first. So organizational structure and the governance. Now the organizational structure represent, we have a different sort of structure for the organization. So for example, the tall organization or the flat organization. So organizational structure can be flat or it can be tall. Now we're going to look at detail later on. So tall organization represent when you have a lot of chain of command. Chain of command means, for example, from the strategic level, till the operational level, we have a lot of involvement. For example, the senior management, then the senior supervisor, then operational management, then the worker. So the chain of command is really, really high. So normally the tall organization, the top level people, they take the decision. For example, the senior management, they take the decision for the company, and they just implement all these rules or the operational activity to the low level management, and they just have to do the work. Normally the operational level management, and they are not involved with the decision making process. On the other hand, we have a flat organization. Flat organization, we don't have too many layers, or we don't have too much chain of command. So for example, we have a senior management, then the supervisor and the worker. So we have like only few steps. So in this process, normally the operational management, they also involved with the decision-making process. Then we have a centralized and decentralized. So centralized organization and decentralized organization. So the centralized organization where the decision is taken from the head office. For example, they have a lot of branches and a lot of operational center or the cost center, profit center, investment center, but the decision is taken mostly by the head office. So this is centralized. So all the things, all the major decision or the strategic people, they stay on the head office and they take the decision. On the other hand, the decentralized is they make a division, they make an individual center, and they give the responsibility or the power to take the decision for that operational center. For example, if you look at the McDonald's, so every McDonald's have a different function, but if you look at their branches, so obviously not all the decision taken by the head office, but the center management or the divisional management, they take the decision for the zone. For example, for the zone of East London, maybe they decentralize it for only for a few branches, for the South London, for the East London, for the West London. So sometime when the organization is really big, they have to decentralize the division or function to make the process a little bit faster. Other than the decision will take a long time to determine any decision or to give any decision, it will take a long time because obviously the process will be long. So sometimes the decentralization could be good for the company because the decision-making process will be faster. Sometimes the centralized could be good for the company because maybe the strategic people will take the better decision for the company. So there is a no good or bad. Both can be good, both can be bad. It depends on the organizational structure. The next one, we have a governance. Governance is all about the rules. It's all about the set of guidelines or the rules, how the business is going to run. So this sort of rules or guidance, we called it governance. So when the director run the business, they follow sort of guidance and the rules, and we called it governance. Sometimes we called it corporate governance, and corporate governance means all the corporate guidelines we have in order to run the business. All right, let's look at our chapter overview. Let's have a look what we have here. On the chapter overview, you can see we have a few things. We have governance, so the governance could be centralized, level of management, and we have a function, divisional, and the metrics. Metrics is like when you have a mixed culture of the organization, or you follow the matrix structure. Then we have a span of control and the scalar of chain, a role of the finance, stakeholder management, and we have the types of risk. Now, on the types of risk, this one is a very common in the exam. Most of the time, you have to answer this question: how to handle the risk. Now, this word called TARA represent how you're going to handle the risk. So T represent transfer of the risk. So transfer of risk. So T represent transfer of risk. A represent accept of risk. Then R represent reduce reduce the risk. And finally, A represent avoid the risk. Now, how you determine this TARA strategies depends on the company situation or the circumstance. For example, when the risk is low and chances of happening that risk is very low, then you can accept it. For example, if you think like the COVID will happen again, now maybe there is a chances like less than 1%, but the chances is a very, very low. Now, for example, because of this risk, if you don't do your business, then you will avoid the risk. Now, for example, if you think like this sort of thing, the pandemic has happened once in a lifetime. So of course, like this is a risk, but I think like this risk, the chances is a very, very low to happen. And I think like this risk is kind of that we can accept because we cannot do much to avoid this sort of risk. So you can accept the risk. Now, when the risk is likelihood is high and the impact is not very high or maybe low. For example, it's not going to damage you too much. Or for example, its chances of happening is higher, but maybe the impact is chances is lower, but impact is higher. For example, let's say you have a phone or you have a TV at home or you have a car. So for example, let's say like happening a damage to your phone or to your car, or like, for example, your inventory on the stock, a likelihood maybe is less. But if it has happened, maybe the impact will be more. For example, if you lost the phone or if you lost the car or if you lost the inventory, so the impact is a very, very bad on you, but chances may be not that high, it's a very less. So in this case, we can transfer the risk. How you can transfer the risk? Through the insurance. For example, if you do the insurance, so if something happened, then they will give it to you back or you can recover from the insurance. The next one is reduce the risk. So when you see like likelihood is high and chances of happening is also high, you try to reduce it. So there is for example, there is a different approach you can follow. For example, if there is a closing inventory on the stock, maybe you put physical stock, physical control, you put the security to try to not do it or damage it. So you try to reduce the risk by following different sort of approach. Now, if you cannot reduce it at all, then finally you have to avoid the risk. How you avoid the risk? You don't do that. So that's the only one way we can avoid the risk. So we have a 4 option. Either we'll accept the risk, either we will transfer the risk or reduce the risk, or finally we have to avoid the risk, not to do that work or not to take that project. All right, so let's move on to inside of the chapter. Let's have a look what else we have. So we have organizational structure. So this is the structure chart. You can have a look later on that. So we have a span of the control. So span of control, it says the number of subordinate that manager can manage. So how many people you can manage under you? This is called span of the control. And the scalar of chain, it says number of link between the board and the most junior employee. So this represents the scalar of chain. Now we have a 2 type of organization we discussed before that. So we have a tall organization and we have a flat organization. Now you can see here the tall organization, we have a lot of thing here that is so you can see we have an MD, we have a divisional director, we have a department managers, we have a section manager, we have a supervisor, charge hand, and the workers. So a lot of a division, lot of people involved with the tall organization. Now the flat organization is a little bit flat. So you have an MD, then management, and then supervisor and the worker. So the chain of command is not very high for the flat organization. Every organization have a advantage and disadvantage both. So there is nothing we can say this is good, this is bad. MD represent the managing director, join up. The managing director. All right, so we have the next thing, we have the corporate structure. So we will look at this one later on. It's not very important. Now look at the governance. This is the most important area here, the governance. So if you look at what is governance, it says corporate governance, the system by which the company are directed and controlled. So this definition you have to remember in the exam, you have to write it. So the system by which the company are directed and controlled. It considers how director can held accountable to shareholder for their action. So if they do something wrong, or if they do something that they're not supposed to do, how they will be accountable for that. So let's quickly read that. Companies are subject to a formal control via the UK Corporate Governance Code, FRC 2018. So this sort of code, or this sort of line you have to remember, because in the MCQ type question, they might ask you like, is it FRC 2018, 16, 17, which year? You have to say it's 2018. All company will be benefit from the effective governance via risk reductions. If you follow the corporate governance, your risk will be lower. Improve the performance. Performance will be improved. Better company reputation. So company reputation will be improved. This improvement are driven by the different two key aspects of the code, including splitting the role of the CEO and the chair. And the CEO is the person who is the chief executive officer, and the chair who is in the board, requiring a majority of the board to independent to non-executive directors. So obviously, like when you have a board, remember the board is the people who take the decision. Now in the board, there is two groups. One is executive director and one is non-executive director. Let's later be talk about that. Executive director are the people who are the full-time employee for the company, but the non-executive directors or the needs, they are not the full-time employees of the company, but they come as a part-time for the company. They work somewhere else. They just come to the company when the decision will be taken. So why we need the both executive and non-executive? So the company need both to find it out, is there any decision will be favored for the CEO or for the executive director. So for example, the executive director, they set up a target like, if this year we can sell 1 million, every director will get a bonus 10%. Now someone need to tell like, no, it is not right, or it is not correct. Or for example, the company says like, in the Christmas we're going to offer 10% discount on every product. Now someone need to say, no, this is not right. So who's going to tell that? The non-executive directors. So in the board, the executive directors and the non-executive directors, the numbers need to be equal. So it is not possible, or it is not recommended like you have a 10 executive director and you have a 8 non-executive directors. So when the decision will come, all the executive director will raise the hand and these rules will be passed and accepted. So it's not going to be helpful. So it has to be equal. So when a resolution or any proposal will come to the board, so at least a majority of the director has to say like, yes, go for that. So if there is a half, so the decision will not be executed. So for that reason, the executive directors and the non-executive director both are important, and both have to be equal number for the company board. All right, the next one we have here, that is centralized and the decentralized. And obviously, like there is some advantage and disadvantage of both. There is no good or bad, depends on the company structure. Centralized organization retain much of the power and decision making at head office. So when you are centralized, most of the power will retain for the decision making in the head office. Decentralized organization delegate more business decision to divisional head. So every division have a head. So you have a small division. Now, for example, it is possible one company have a 3 product. For example, if you look at the Lloyd's group, now they have a Lloyd's Pharma, they have a Lloyd's Bank, and they have a Halifax Bank. So for example, they have a 3 product. Now, if they take the decision centrally for the all three product, it will be time consuming and the decision will not be faster. Rather than they have a three division, and if they make a division and make a head for each decision to take the decision, and that will be quicker and it will be decentralized. That will be more faster for the company, and maybe the decision process will be more faster than centralized. But if the company sell only one product, maybe they will go for the centralized because maybe the decision will be taken from the head office. All right, so we have some more information here. Now we have the level of the management. Let's try to understand the level of management. So we have a strategic level. This is the top level people, top management. So the top management are the people who basically make the strategic plan. Strategic plan is the plan that make for the business for at least 4 to 5 years for the long run. For example, where you want to see your business after 5 years. So who will make the plan for that? The strategic people. So this is like very experienced people, the top level people, they sit on that level. They are the people that make the long run decision for the company. The management people, they are on the middle. So they are basically mainly with the involvement with the day-to-day budget, the forecasting, and looking for the estimated profit, and on the research, this product will be viable to launch in the market right now. Shall we delay, or how much will be the profit? How many units we will be able to sell? So this is their job. They're like the middle level management, and they are mainly with the budgeting and the forecasting job done by this level of this group of people. The last one we have this is the middle level, and the operational level people who actually done the job. So strategic people, they make the plan, and this plan come to the management. They actually see the suitability or the feasibility of this plan in the market and waiting for the right time to execute it. And when they're ready, they give it to the operational department, and they are the people who actually do the work based on their plan. All right, so if we look at the next topic, we have the risk management. So we have the risk versus uncertainty. So let's read this two definition. Is very important. Risk: the condition in which there exists a quantifiable dispersion in the possible outcome from any activity. Example, the possibility that actual result will turn different from the expected. So this is a risk. For example, when you do the variance analysis, we always know my actual result will never be expected. For example, if someone asks you, how many units we're going to sell for this summer? It's very hard to predict 100% correct. You can go close. We can say like I'm going to sell 20,000, but actually it could be 18, 19, or can be 22 or 23,000. So this is the risk, and there's some factor of the risk why it's not happening. For example, this summer there is not much long. The summer was short period. People didn't buy, let's say, a lot of, let's say, ice cream. So if we sell ice cream, so the expectation was to sell a 1 million unit, but actually the summer was short, or it wasn't hot enough to buy a lot of ice cream. So the factor is the weather here. So there is a seasonal variance and other impact could happen. So there is a risk, it could happen, and analyze the risk factor. And the risk can be looked at in two ways. A downside, that something could go wrong and the effect is damaging, and upside where things work out better than expected. When thinking about the risk, business are generally thinking about what could go wrong. So they look at the risk factor, like what happened if there is a breakdown of the machinery. So we have a factory, what happens suddenly one factory stop working? What happened if there is a suddenly there is no people to work? So this is the factor they consider, so that they can fulfill the requirement to reduce the risk. On the other hand, we have uncertainty. Uncertainty is all about the intangibility to predict that outcome from the activity due to lack of information about the input and output relationship or about the environment which the activity takes place. So obviously, for example, if the COVID come back again next year, no one knows it. So that's uncertainty. Or maybe another pandemic could come, or maybe a cyclone can come, or another natural disaster can come. This is a very uncertain. No one can predict it because it could happen. So the risk, you can analyze the risk factor and you can take action to reduce the risk. But the uncertainty, you cannot do anything because you really don't know what's going to happen. All right. So normally, obviously, like when you have a word, we called it, sometimes we called it probability and the possibility. So when we have a more chances to happen something, we called it is probable. So normally you understand if the chances is more than 50%. For example, if a company throws some wastage in the sea, and the environmental agency, they make a claim against that company, and the solicitor said, like, most likely you have to pay some compensation for that. That means if you ask, like, what is the chances, if the solicitor say it is more than 80%, that means it is probable. There is a probability you're going to pay some compensation. If this is the case, you have to take it seriously and you have to keep a provision for that. But if, for example, one customer is not happy with the services, and if they make a claim, and if you know, like, it's nothing going to happen, the chances to win the claim is maybe 10-20%. So you called it a possibility. So obviously the possibility is not something, you have to keep the provision for that. So you can just keep a note for that, like maybe it could happen, but the chances are less than 50%. So really don't have to worry, just keep a note for that. We don't have to keep a provision for that. All right, so the next one, we have some risks. So you can see here we have some strategic risk, we have some operational risk, and we have business risks and the non-business risks. Let's quickly read this all four types of risks. First one, we have a strategic risk. Are those affecting or created by the organization strategy or a strategic objective. So when you make a long-term plan, if there is a problem and if something happened with that plan, that could be a strategic risk could be created. This tend to be long-term risk, and the organization is exposed to and are prominently influenced by the external factor. This could be include the competitor action or changes in the government policy or switching from the fossil fuel to renewable energy. So this is could be happen. For example, you are planning to make a car, petrol car, and you have a lot of investment. You're making a plan for next 5-10 years, and after 5 years the government said, like, okay, we have decided no more petrol engine, no more diesel engine, only the electric car. So you will have a lot of obviously like risk on your strategy, and this one obviously like could happen because of the government policy changes and something come up, so that will affect you long run. The operational risk are the major risks that affect an organization's ability to execute its strategic plan. So if they give you the plan, the strategic people, and if you find it difficult to execute it, then that's the operational risk. This can also be thought of as things that can disrupt the daily function of the organization. These are largely related to the internal factor. Example, machine downtime, staff going for a strike, industrial accident, failing to comply with the industry-specific regulations, system being hacked, and somewhere being installed. So this sort of thing can create an operational risk for your company. Business risks are those that are specific to the organization because of the interest that they are greater in. Example, product failure, poor investment, and changes in the law. Non-business risk affect all organizations irrespective of the industry that they operate in. Example, event risk such as fire and flood, and financial risks such as recession. So that we are going to be next 2 years. So UK will be on the recession. So this will have impact on the business. So 2023 and 4, the Bank of England already gave us the warning. So we'll have a recession. So everyone has to be careful with that. So they are saying like, if you're spending a lot, so it's not the time to spending a lot. Next 2 years, you will be in a recession. So try to save some money because the interest rate is higher now, inflation rate is higher. So this could have a negative impact on the business. All right, the next one we have here, how to manage the risk. This one we already talked. So we have TARA, so transfer the risk. For example, the insurance, avoid the risks, don't do it, stop making the product completely, reduction, try to reduce the risks, implement the control, and accept the risk. Like this is a part of, there is no business in this world without any risk. So some risk is always has to be taken. If you want a zero risk, you cannot do the business. So some sort of risk you have to accept if you like to go for a business. So if you see the risk is low and likelihood, impact is low and the likelihood, the chances of happening is low, you should accept the risk. If it is impact is higher, but likelihood is low, you can transfer the risk. If it is impact is lower and the likelihood is high, try to reduce the risk, and both is high, try to avoid it. So chances of happening is higher, and also the impact, the damage happened to the business also higher, try to avoid the risk. This is very common in the exam, how business deal with the risk with this TARA model, so you have to remember that. All right, so the next point we have a stakeholder. So let's try to understand the stakeholder. It's not a very difficult thing. Stakeholder are the people who is who is like getting impact or get affected by the decision of the business. So if the business took any decision, somehow if you or anyone get affected because of that decision, then he or she is the stakeholder. For example, let's say if you work for a company and if the company decide anything, then what will happen? You are employee for the company. For example, your working time, your working location could be changed. So you are a stakeholder. For example, you have impact on your salary, on your pension. You will be a stakeholder. The management is the stakeholder. The shareholder is the main stakeholder because they're looking for the return. The government is the stakeholder because they're looking for the tax from your business. The customer is the stakeholder because they buy the product from you. So everyone is kind of the stakeholder. So the definition of the stakeholder is like if anyone get affected by the decision of your business, they are your stakeholder. So if you have a stakeholder, a person, a group, or group of persons who have stake on your organization. So you understand this, what does that mean? So because of your decision, if they get influenced or if they get affected, they are my stakeholder. Now we have a internal stakeholder, we have a external stakeholder. Internal stakeholder, the people who work for the business. For example, the management, for example, the employees, they are internal stakeholder. External stakeholder, for example, the bank, for example, the supplier, they're my external stakeholder. Now we have two more things. Stakeholder can be classified as a primary. So primary, those directly affected by the decision, for example, the owner, manager, staff. Secondary stakeholder can be indirectly affected by the decision. For example, we say the customers, so they might have an impact who may still be able to exert some influence over the company. Now let's read this one, activity 2. And see like what is the question here. So Wasim and Walker have decided to close down their factory in Greenland. So they have decided to close one factory in Greenland. They believe that production can be switched to their other manufacturing facility in Billund, where labor, overhead, and taxation are much lower. So they're closing one factory and they're moving somewhere else, some other city, some other country, doesn't matter. So they're moving somewhere else. Requirement: identify 3 groups of people affected by the decision, and for each briefly explain the nature of their interest. So stakeholder. So the first one we can say here, if we close the factory in Greenland, so we can say the employee in Greenland, So Greenland, it's not green, it's Gieland, okay. So employee in Gieland, they will lose their job. So they are the stakeholder in Gieland. So basically it's the nature of the interest. They will lose their job. Because if you close the factory in Gieland, so we don't need an employee there. Then the factory in Beeland, there we're going to start or opening a new factory. So we said Beeland factory. So here, the people will get the job here now. So there'll be new opportunity will be created. So for that area's people, they will be the new stakeholder. So we'll say that will be the new stakeholder. So there might be a job opportunity. So new job opportunity. Then the government in Gieland, they are also stakeholder, government of Gieland, because they'll lose the tax. So no more tax from this company. And the supplier in the Gieland, obviously they are not going to get any more order from this company. So the people who will be affected because of your decision, actually they are your stakeholder. This is a simple definition. All right, let's move to our next one. What else we have? So you can see here we have some stakeholder internal, that is corporate management employee, connected stakeholder, shareholder, bank, supplier, external stakeholder, the competitor, government. So you can read this thing. It will obviously like give you more idea about this, but you need to know the main basic thing that will be help us to understand more. Okay, let's read this one quickly. Illustration number 2 is stakeholder analysis. The government is considering an outright ban on the sale of new gas boiler as a part of its drive to make the country carbon neutral. As a result, any new or replacement boiler installation would need to be used heat pump technology, which is more expensive than existing gas-fired technology, who may be affected by this decision. So if the government said like from now you'll not be able to use the normal boiler anymore because it is not carbon dioxide friendly, so they can take a decision on this COP 2016, blah blah blah. So they have so much with the climate change, so they can take a decision. So who will be affected because of that decision? So you can say people with heat pump boilers, so who already using this boiler, so minimal effort, they already have a new technology, so are unaffected by the decision. So the people who is already using the heat pump boiler, the government said you need to use only that. So if there's someone already have this, they have nothing to worry. So they will not be impacted by the government decision. They'll say, oh, the government make the new rules, don't use it, I already have it. For example, in London now, they are saying like you cannot use the diesel car for that engine, so they make ULEZ, and they make like in Germany they said by 2026 they will not use any diesel car anymore. So there is some city they're banning this thing, so they're making a lot of changes. So if someone already have the electric car, he don't have to worry about that because he said like I'm comply with the rules, so I have electric car, so I don't have to worry about that. Boiler manufacturers, so they will be affected, keep informed. They are unlikely to be able to block the decision and must be braced of the new law, and they can get ready to comply with it. So obviously the production center, they have to comply with the law. Maybe they will not be able to do anything because the government law they have to follow. People with the old boiler, keep satisfied. Government must win election to change the law. So any move that obviously the voter can be angry, who may be faced with expensive upgrades, may be unpopular with the electorate. So obviously, like if the government do something, and if the people are not happy, maybe they will not be happy with this government. So you'll have an impact on that. MPs, the key player. Although the government will draft and process the new legislation, it is Parliament that will vote on accepting, rejecting, or modifying the new law. Without support of the major MP, the proposed law change will be defected. So even though the parliament make the new law, but it has to be passed by all the MPs. If in the House of Commons they said like, okay, maximum MP said no, this one is not the good for the country, or if this rules cannot be passed, it will have a negative impact of the people. So it will be defected, it will be rejected by the MPs. So because of this decision, all these people will be affected somehow. So all of them will be stakeholder. All right, any question from anyone? All right, very good. So I think this is the end of our chapter number 2. So as I said, this chapter will be like, this book is like kind of all theory, a little bit boring, but we have to do it. We don't have much choice, but we have to learn as well, like what we're talking. So you need to make sure you're learning something, and you have to revise yourself as well. And that's how we can make ourselves ready for the exam. As I said before, you need to make sure like you have a good typing speed. If you don't have, make sure you start your typing speed, because in the exam you have to write a lot, especially for this exam. How do you prepare for this exam? Also, the old course, it's not on the old course. This is not old course at all. This is the new exam. So you need to make sure like you have the access to your AAT portal. If you're not registered yet with the AAT Q 2022 new syllabus, you have to make sure you register. Once you register with the AAT, they will give you the access. And once you log into your My AAT portal, you will see there is an exam type of question. So for every single module we are doing, there's a 2 practice paper in the AAT website. So exam format will be exactly look like that. And you can make yourself ready by revising this 2 question. All right. Any more question from anyone? All right, so next week we're going to start our chapter number 3. We're going to look at the external environment. So we're looking to look at our pestle analysis and other things. So next week we will do our chapter 3 and 4, and that's how we'll carry on. In 4 weeks, we'll complete the book, and week number 5, we'll do a revision, and you will be ready for exam.